How are financial advisors perceiving recent market events? Stay with me. First things first, I want to say that everything in this video should not be interpreted as financial advice. Financial advice is customized to you, and to receive that financial advice, you should speak to your financial advisor, accountant, or whoever assists with your finances. Please don't take anything that I am saying in this video as financial advice or take any action based on the information in this video. If you've been paying attention over the last several weeks, we have seen a decline in stock market performance. It's in excess, slight in excess of 10%, and in the financial services world, we call this a financial correction. Now, if you pay attention to the media, a lot of the news and media reports can be perceived as quite alarming. In the financial advising world, we're not as alarmed, or we're not really alarmed, because corrections typically happen once every few years. We've seen corrections before. Now, I'm going to tell you how I, as a financial advisor, perceives corrections that happen in the market. And this is based on my experience of almost a decade of being a financial advisor, but also my training as a certified financial planner, certified private wealth advisor, and what we've been taught to do. So first, we're taught not to panic according to market events. I've been through one Trump presidency and a pandemic, and I've seen every permutation of what can happen in a market, and we're always taught not to panic. We're taught to assess and evaluate the situation and make decisions going forward. So first of all, the stock market. The stock market relies on leading indicators, meaning it's trying to predict the future based on what's happening. And when Trump was reelected and won the presidency back in November, there was a lot of optimism from corporate entities and from the stock market. That optimism centered around thoughts that Donald Trump would lower corporate taxes and also lower corporate regulations. The stock market and corporations read that as opportunities for growth and profit, and so it pumped up the stock market. There was a big run up after Trump was elected. Now, since Trump was inaugurated for his second term, we've gotten tariffs on two of our largest trading partners, Mexico and Canada, and we've gotten DOGE. Now, tariffs are usually not good for an economy. It drives up production costs, and it also has a hand in driving up inflation. DOGE, we don't know what to make of it yet. Tens of thousands, if not hundreds of thousands of federal employees have lost their jobs, which means a spike in unemployment numbers. Private entities and corporations can't absorb all these public workers, and the U.S. government is the largest employer in the United States, so that's not good. So a lot of the promise, a lot of the enthusiasm, a lot of the buildup after the November election has simply evaporated. And because the stock market is a leading indicator, relies on future predictions, it's begun to peel back a lot of that optimism it built into the market to say that what we thought, lowering of corporate taxes and lowering of corporate regulations, obviously isn't the priority of this administration, at least not yet. So we're not going to factor that into the market anymore. So you saw a rapid pullback of the market starting in mid-February. So as financial advisors, we definitely are paying attention to that. We also pay attention to something called lagging indicators. Unemployment numbers are always based on lagging data from months before. Inflation numbers are always generated based on lagging data. So there's leading data and lagging data that we are watching to kind of get a prediction of what is going on in the market. Now, what are financial advisors doing in either our own portfolios or in client portfolios? Typically, if there is a 10% correction, we are watching what is going on. But typically, in most portfolios, we're really not doing much of anything, and that is absolutely the correct answers. So let me explain why. So in my clients who have large cash positions and who have an appetite of risk, now maybe this is a buying opportunity in the market. I have had some clients who had hundreds of thousands of dollars or even millions of dollars sitting on the sidelines for a variety of reasons, who I've called and say, hey, let's put all of this or some of this into the market because basically it's a 10% off sale right now. And my clients who have an appetite for risk really like that concept. Now, not everyone can do this. A, you have to have cash on the sideline that you can put into the market, and B, you have to have an appetite for risk. But there is a subset of clients where this is just a buying opportunity. Let's get on board. Those clients are typically younger. They typically have more assets so they can take on the level of risk, and they typically have a much longer time horizon. They're not going to need this money for the next 40 years, and they just see a buying opportunity. Now, for some other clients, it may be an opportunity to make tweaks in their portfolio. I don't like making tweaks in people's portfolios when the market is dropping, but hey, there have been clients who I have been making suggestions for years and they just didn't want to do it. But in the market drop, their ears are open and they're paying attention. And so they're finally willing to make the adjustments that I suggested many years ago. And I'm not going to fight them on this because these adjustments are long overdue and need to be made. Think of a person who's maybe in their 40s who has a really aggressive profile for retirement. I've been talking to them for years that we need to pull back a little bit, put in a bond structure in their retirement portfolio. Because the stock market has done so well in 2023 and 2024, they've ignored every conversation about it. But now they are paying attention. So, while I have their attention and while they are willing to act, I'm often willing to do it because I know if the stock market recovers, they're going to change their thinking and they're not going to be willing to make the adjustments in order to bring the portfolio in alignment with their age, income, risk tolerance, and goals. So in some cases, I'm making some tweaks in portfolios. But for the vast majority of my clients, I'm doing nothing. I'm watching and I am waiting. Why? Well, as I've stated before, I really don't like making adjustments unless it's absolutely necessary during a falling market. It's like trying to catch a sharp knife that's falling off a counter by the blade. It just doesn't end well for anybody and it ends up causing a lot of problems. Another reason why I may make adjustments to people's portfolio is because of tax harvesting. People need to harvest loss on years. There are a few assets that maybe we've had some questions about. It's down now and they can maximize the loss on this particular asset. Let's go ahead and sell it and put that money towards something else or generate that loss on the year. But once again, it represents only a fraction of the clients. The reason why I don't make a lot of changes to clients' portfolios, if the person is in a brokerage account or in a joint account that is not retirement, it creates something called tax drag. Now, tax drag is pretty complicated to explain. It's its own, half an hour video. But basically, anytime I buy and sell anything, it generates capital gains. And if you buy and sell a lot, you end up generating a lot of capital gains. Some may be short term, some may be long term, and you basically corrode the overall performance of the account due to taxes. So a lot of financial advisors don't necessarily talk about tax drag. It's something that we know that goes on behind the scenes, but we really don't bring it to the forefront. But I'm very careful about making changes to clients' portfolios when they are individual brokerage accounts or joint accounts. My philosophy is choose good assets that have low internal costs and keep those assets for as long as possible. Now, if there's a problem with the asset, you change it out. But if there's not a problem with the asset, and in this case of what's going on in market correction, it's usually not a problem with the asset. It's an overall issue of economic policies being uncertain. IRAs and Roth IRAs, it's a little bit different because you don't have to worry about tax drags. I'm a little more optimistic about making changes in IRAs or Roth IRA accounts. But what I have noticed in my 10 years of being a financial advisor is that trying to make changes according to Trump economic policies is just wild. Is it growth? Is it value? Is it something else? At the beginning of the year, it was growth. Now it's switched over to value. 2 weeks from now, it may be back to growth. And you can't keep flipping people's portfolios or flipping people in and out of things. You have to pick a strategy and just move forward. And like I said, when that strategy no longer works or there's a problem with that asset, you move it out. But Trump presidency and Trump economic policy is so volatile and changes so much. It really is impossible to build the perfect portfolio that responds to every single Trump economic policy change. Now, what are most financial advisors doing? Well, we are paying attention to what's going on, and we're watching and we're waiting. We're waiting for leading indicators, meaning we're watching what the stock market is doing, and we're also watching what this political administration is saying and doing. But we're also looking very heavily at those lagging indicators. We're looking at unemployment numbers. We're looking at inflation. We're looking for possible signs for recession in the market. What do many financial advisors do in recession? Well, for younger clients, is basically hold the position and hold on tight. Now, for older clients who are closer to retirement, it's a much more nuanced answer and requires a lot of planning, and that's an own video in its own right that maybe I will do at some time in the future. But basically, making changes according to market corrections for most financial advisor is not the right condition. It's really hold on, watch what's going on, and if changes are needed, make them. But most of the time, changes are not needed because it's not the assets that are creating a problem. It's overall economic policies that are creating issues right now. So there you have it, a perspective from a financial advisor. Tell me what you agree with, tell me what you don't agree with. And if you found this information useful, please like, share, and subscribe.